Okay, welcome back to the Personal Finance, Unit 5, Fundamentals of Investing, Part 2. Now, we left off right around the index fund. So let's start talking about what an index fund is and how it can impact an investor's options of investing. So an index fund is a type of mutual fund designed to reduce the fees by investing in stocks and bonds that make up an index, which is another category of investments. This is a group of similar stocks and bonds that are put into one particular fund. An example of this might be the Standard & Poor's 500. So the Standard & Poor's is the index, and that would be the fund then that the investor would choose to invest in. Now, when it comes to investing, an investor can either lend or own. So when investing, consumers lend money to a company or an organization, or they own the asset. If they lend, they are typically going to be investing in bonds. The return on that investment is going to be interest. If the investor owns, now the investor is investing in stock, real estate, or speculative investments, and the returns here are a lot. There's more potential for return in terms of dividends, rents, and even capital gains. So both are very viable options of investing, a little bit different as to how the investor sees the return. Now, when it comes to knowledge of the general risk level, the level that helps manage the risk, if we take a look at lending versus owning, first of all, the type of return. Lending, you're only going to get interest, whereas owning, you're going to get dividends, rents, and or capital gains. Now, the type of investment for lending is going to be a bond, a mutual fund, or an index fund, whereas the type of investment for a dividend is going to be a stock, mutual fund, or index fund. Rent will be real estate or mutual fund. Capital gains, stock, mutual fund, index fund. So you can see if you own it, you've got more potential options for return. Now, when it comes to lending, the decreased inflation risk, whereas owning, there is an increased potential for higher returns, equaling an increased investment risk as well. So normally an investor is going to want to have both of these in the investment portfolio, not just owning all stocks, not just lending all bonds or mutual funds or index funds, but having a combination of both. Now, when it comes to characteristics of investment tools, let's take a look at the triangle on the right first. As the triangle comes to the narrow peak, that is the increased investment risk. So that's going to be our speculative investments, our stock and real estate, our mutual funds and index funds, and then followed by bonds, which is our lowest amount of risk. If we compare that with the boxes on the left, order cards from the lowest to highest, the investment risk highest is going to be speculative, and the potential for returns is going to be best with a stock, real estate, or mutual funds, and the lowest inflation risk is going to be our bonds. Now, in investment philosophy, everybody's going to have a different philosophy as to how they want to invest. If someone was an aggressive investor, what type of investment tools would primarily have in their portfolio? Well, if we go back to the types of investments that we have discussed, we know that that the higher the risk, the higher the potential for return. Everybody's going to have a different tolerance of risk. Risk tolerance is usually categorized into conservative, very low risk, moderate, a medium amount of risk willing to be assumed, or aggressive, a significant amount of risk being willing to be assumed. Normally, if you're going to go conservative, moderate, aggressive, or a combination of any of the three, it's going to depend on the amount of time that you have that you will be investing. The more time, the more risk you can absorb, because the more time that risk can dilute. Whereas if you have less time, you want to be more conservative because you don't want the risk of losing that money. You want the potential you want more potential for gain, even though it's not a higher gain. Now, portfolio diversification, in order to diverse our money, which means put it into a bunch of different areas to reduce risk, that is the purpose of diversifying our portfolio, is to reduce the amount of risk through an array of investments. We want to create a collection of investments that will provide an acceptable return with an acceptable exposure to risk. Everybody's slightly different. The ultimate goal here is to reduce the investment risk as much as we can and maximize our potential for return. Now, investing in mutual fund is an automatic form of portfolio diversification, which makes it such an attractive tactic when it comes to investing. Mutual funds can provide a lot of different scenarios: high risk, low risk, high return, low return. And at the same time, it's diversifying your portfolio while you're investing in that mutual fund. Now, the stock exchange, there are a couple of different ones. The ones that probably are most common or that we know of are the New York Stock Exchange and the NASDAQ. These investments are purchased from the stock exchange, except for real estate and some other speculative investments which may not be traded on the stock exchange. And when it comes to the stock exchange, it is a centralized organization where the sale of stocks and bonds are done and traded. That is a worldwide type of a trade, so there are also international stocks that can also be exchanged. Now, only a limited number of people are allowed to buy and sell the stock directly. We, as individual investors, cannot do that, which is why we need brokers. Now, brokers, also known as brokerage firms facilitate the buying and selling of investments in stock. Now, when it comes to discount versus full service, in terms of brokerage firms, the discounts that brokerage firms are going to provide to their investors is they will complete the orders and buy and sell the investments, but advice is not offered in regards to discounts. Now, when it comes to full service, they are going to offer investment transactions and a financial advisor. The financial advisor is a trained professional that helps make investing decisions, thus informing the investor on what to buy, what not to buy, trends in the market, so on and so forth. So brokerage firms can be very advantageous if you are using the right one, and the services that you are desiring are the services that they are providing. Now, when it comes to discount brokerage firm fees, unfortunately, nothing is free. So usually there's going to be a fee that is going to be charged for completing the buy or sell of a transaction. These fees may include a service fee, a maintenance fee, an inactivity fee, or a fee specific to a particular investment. Now, total fees are often lower, but an individual must have the knowledge and the time to monitor investments. Inactivity fee, fees that are charged for the account not having any activity associated with it in terms of buying and selling. You got to watch out for that as well. So make sure that you are active in your investments as they are evolving. Now, when it comes to a full service brokerage firm, the fees that are associated with that is, first of all, let's understand that financial advisors are compensated for their time because they are providing a service that they provide the investor. Most charge fees using one of the particular methods on the right-hand side here. So it might be a percentage of the investment value. It might be a percentage of the amount invested. It might be an hourly rate and or even a flat fee. Now, in addition to fees, financial advisors may earn commissions paid by the company. So financial advisors aren't only working for the investor, they're also working for the investment organizations that provide investment options. So financial advising can be a very, very lucrative career, as there's two different ways of being compensated for your service. At the same time, provides an excellent service for the investor as well as the companies providing investment opportunities. All right, so when it comes to choosing a brokerage firm, some of the things that we might want to ask, it's important to research the financial advisor and the firm that he or she works for. One question to ask is, how are the firm's financial advisors compensated? This is probably going to be passed on to the investor in terms of fees, thus informing the investor of which is the possible best option. How long has the firm been in business? Are they established? Are they new? If they are established, they've gone through some highs and lows and have come out on the other end and still in business. Does the firm have a history of positive reviews and success? Are past investors happy with the services that are provided? How does the firm rank in comparison to other brokerage firms? Is this my best possible option, or is there a better option available to me? Now, taxes is another aspect of investing which we have yet to discuss. The government encourages people to invest in certain types of investments. Now, when it comes to savings and investments, they are a form of unearned income and therefore are subject to income tax. So anything that is earned on our investment is taxable income. Now, tax-advantaged investments, these are going to reduce, defer, or adjust the current year tax liability. Most common are retirement and education. There are different retirement accounts out there which you can disperse. Not disperse is the wrong word. delineate as to when you want to pay that tax. Do you want to pay it up front or do you want to pay it later? So that you can kind of absorb those tax risks so that when you start pulling those retirement funds, you're not being slammed all at once by those taxes that are owed. So when are taxes for tax advantage investments usually paid? Money is invested, taxes are paid. Money grows untaxed with help from compounding interest, or money is withdrawn. Another option is taxes paid when money is invested. I'm sorry, I say that again. Money is invested, money grows, money is withdrawn, taxes are paid. So you either pay the tax on the front end or the back end. Most investors will have different types of investments in which taxes are paid in the front end and the back end to kind of diversify those taxes as to when they have to be paid. IRA, taxes are paid up front. Roth IRA, taxes are paid on the back end. I'm sorry, reverse that. IRA taxes are paid in the back end. Roth IRA taxes are paid up front. Now, when it comes to investing for retirement, mutual funds is a very common option. You can contribute money typically it's tax advantaged, but you can contribute money on a monthly basis, annual basis, however often you want to do it. When possible, use an employer-sponsored plan. Sometimes employers will match the individual's funds that are invested in there. So if you invest 3% of your paycheck, your employer will match that. So thus 6% of your paycheck will actually go into your investment account. Very nice option to have. Take advantage of it if your employer offers it. Retirement accounts. Here are some that are out there. There is a 401k, a 403b, which is a tax exempt. There's also personal retirement accounts such as IRAs and Roth IRAs. Now, the trade-off and the tax advantages in most of these accounts have penalties if money is withdrawn early. But in order to delineate the difference between when taxes are paid, a combination of these different retirement accounts are advised. There are many other types of plans available. These ones here are the most common. Now, in summary, based off of what we discussed, investments are important to building net worth. Remember that. Investments are ideal for long-term financial gain. Don't forget that. Discuss your goals with a financial advisor. They are the professionals and they can help you put together an investment plan that works best for you. A trade-off to higher return is lower liquidity and higher risk. Take advantage of different portfolio diversification options and make sure that you understand tax advantage investments and employer-sponsored plans. All right, this concludes the presentation lecture for Personal Finance, Unit Number 5, Fundamentals of Investing, Part 2. Please make sure that you go back and revisit the slides if need be in order to complete your notes, and I will see you next time we meet in class.